Fibonacci. Just the name sounds impressive, doesn't it? It's a super powerful tool that has helped traders create some truly successful strategies. But here's the thing, what if we didn't stop there? What if we took this already incredible tool and paired it with other indicators to create a strategy so sharp? That's exactly what I've been working on, a way to combine Fibonacci with other powerful indicators to not only maximize profits, but also minimize those pesky little errors that can sneak in. Now let's be real, there's no magical indicator out there that guarantees 100% winning signals. We're not here chasing magic wands or crystal balls, but by using smart combinations of tools, we can get much closer to making consistently good trades. If you're on the same page, let's dive into this video and break it all down.
Day traders have it all wrong. They see the market run up, they sell it. It comes down, they buy it. It runs up, they sell it. It comes down, they buy it. It runs up, they sell it. And then, whoa, prices take off and they sell and they lose money all the way up, not realizing the only way you make money in the market is to catch a trend. It doesn't matter if you're a day trader or a long-term trader. Trend is the basis of all profits. You need a trend.
These is a golden rule all profitable traders live by. Trade with the trend. That's where the moving average exponential comes in. It's like our market compass. To get started, add the EMA to your chart and set the length to 200. Why 200? Because this setting helps us identify the long-term trend. If the price is trading above the 200 EMA, it's a strong signal of an uptrend, a bullish market. On the flip side, if the price is below the 200 EMA, it indicates a downtrend, a bearish market. Once you've added the indicator, the first step is to switch to a higher time frame, like the 1 hour chart. Check where the market is relative to the 200 EMA. In this case, the price is above the 200 EMA, signaling a long-term uptrend. That means we're only looking for opportunities to take long positions and ride the trend to profit. Simple, effective, and exactly what you need to stay on the right side of the market.
Hold on.
Where's Fibonacci in all this?
Don't worry, we're getting there. But first, we need one more key ingredient to make this strategy even better.
Nice.
If you're great at spotting support and resistance levels manually, that's awesome. But if you're looking for some extra help, there's an indicator that makes it super easy, LuxAlgo's support and resistance tool. I've even made a video walking you through how to find high-quality support and resistance levels, so be sure to check it out. I'll leave the link in the description for you. Once you've added this indicator to your chart, it'll instantly highlight key levels, and your setup will start to look like this. Now, here's the fun part. This strategy shines on shorter time frames, so we'll focus there. Next, we bring in Fibonacci. Go to your Fibonacci tool, and in the settings, enable only the key levels you see here on the screen. Now that our tools are in place, let's put it all together and dive into the strategy itself. Remember, we're only trading with the trend, no exceptions. So, the first step is to switch to the 1 hour time frame and check what the market is doing. In this case, we can clearly see that it's in an uptrend. Perfect. Now that we've confirmed the trend, switch to the 1 minute time frame for precision entries. Here's where the magic of Fibonacci comes in. Select your Fibonacci tool and mark the levels by dragging it from resistance to support, or simply from red to blue zones. Once done, you'll see 3 key zones highlighted on your chart: green, golden, and red. The rule is simple. We're only going to take a trade if the price pulls back between the green and golden lines. These are our high probability entry areas for catching the continuation of the trend. Now, here's the crucial part. I'm going to walk you through the possible scenarios step by step, so pay close attention. Each case has its own twist, and knowing how to handle them can make all the difference in your success. Let's break this down with a real example. First, take a look here. The price gives us a clear resistance level and the support. Perfect. Now we're going to use our Fibonacci tool, dragging it from the resistance, red line, to the support, blue line. Then we wait for the price to retest those key zones. Uh-oh, the price has already taken off. No need to worry. There's always another opportunity in the market. Patience is key. So we wait for the next setup to appear. And here it is. The price has moved, and now we use our Fibonacci tool again, focusing on the golden zone. This is the area we're watching closely. After some time, the price finally pulls back to the golden zone. But wait, are we jumping in now? Nope. We don't take a trade yet because we need confirmation first. So, we hold off a bit longer, and what do we see? 3 marvelous candles appear shooting stars. This is the confirmation we've been waiting for. It's now the perfect opportunity to take a trade. Here's the plan. We'll place our stop loss just below right here and set our take profit up here, aligned with the trend. And now we wait. Boom. Profit secured. This is how you trade smartly and stay in control of your strategy. Let's look at another scenario. Here, the price gives us clear support and resistance levels, so we use our Fibonacci tool to help us identify potential reversal zones. We wait for the price to come back into the golden zone, and sure enough, it does. As you can see, it's also at the EMA lines, and the price is rejecting that zone. This is a signal for us to take a trade. We then set our stop loss and take profit levels, just like I showed you before, and wait for the trade to play out. Unfortunately, the trade ends up as a loss, but that's okay. We're not going to revenge trade. As I've mentioned before, there is no such thing as a 100% accurate strategy. It's not about winning or losing a single trade, but about being consistent and disciplined. So we don't get discouraged. We simply wait for the next setup to appear. I'm going to end this video with these advice from professional trader.
What do you need to succeed on an intraday trade?
You've got to have a lot of discipline. Discipline is one of the biggest factors as a day trader, because you have to have the discipline to be able to sit on your hands and have that discipline to sit back and have the patience to not force it, not impose your will onto the market, because sometimes the market just isn't giving it to you. You've got a certain kind of style, but the market on that particular day is just drifting sideways. But your style might be, you're a trend-based trader. So don't try and force it to try and think, oh, well, it's going to break out and there's going to be a trend today at some point. It's not always the case. So discipline in many factors, the discipline to be able to sit on your hands and not take trades, the discipline to not revenge trade after you've just had a losing trade and not think, oh, I've got to go straight back into the markets. At all levels, discipline is the biggest factor.